Ever wonder how some people make money while they sleep? Well, the secret lies in the art of investing. Investing isn't this mystical realm reserved for the super rich or financial wizards. It's a practical, accessible tool that can transform your financial future. Many of us have misconceptions about investing. We think it's too complex, too risky, or that you need a large sum of money to start. But that's not the case. Investing is about making your money work for you, not the other way around. It's about planting seeds today that will grow into fruitful trees tomorrow. And it's not just about picking a random stock and hoping for the best. It's about understanding the market, making informed decisions, and having a clear strategy. It's about patience, discipline, and a willingness to learn. Investing is not a game of luck, it's a game of strategy. So, what exactly is investing? Glad you asked. Investing at its core is the process of allocating money in the hope of making more money. Yes, it's as simple as that. You set aside a portion of your hard-earned dough, put it to work in various avenues, and then sit back and watch it grow. But of course, it's not just about sitting back and watching. It requires careful planning, a bit of research, and a whole lot of patience. Let's break it down a bit. When you invest, you're essentially buying an asset you believe has the potential to increase in value over time. Now, these assets could be anything from stocks and bonds to mutual funds and real estate. Each of these has its own unique set of characteristics, benefits, and risks. Stocks, for instance, give you a share in a company's profits and losses. They can be quite volatile, but they also have the potential for high returns. Bonds, on the other hand, are safer, but their returns are typically lower. They're like loans you give to companies or the government, who then pay you back with interest after a certain period. Then there are mutual funds, which are essentially a mix of stocks and bonds. They're managed by professionals and are a good option for those who prefer to sit back and let the experts do the work. And of course, there's real estate, a tangible asset that can provide a steady income stream and potential tax benefits. But remember, no matter what type of investment you choose, there's always a degree of risk involved. The value of your investments can go down as well as up. That's why it's crucial to diversify or spread out your investments across different types of assets. It's like not putting all your eggs in one basket. So to sum up, investing is all about putting your money to work in a variety of avenues with the expectation of a certain profit in the future. It's not a get-rich-quick scheme, but a long-term strategy to grow your wealth. Investments are like seeds. They need time to grow. And the more time you give them, the bigger they can grow. So, are you ready to sow your seeds? Ever heard of the phrase buy low, sell high? Well, that's the essence of the share market, a place where people buy and sell shares, which are units of ownership in a company. It's like an auction house where buyers and sellers negotiate the price of shares, aiming to make a profit. Let's break it down. A share represents a fraction of ownership in a company, giving the shareholders a claim on the company's assets and earnings. When you buy a share, you're essentially buying a piece of that company. Now, where do these transactions happen? They happen in a place called the stock exchange. The stock exchange is a marketplace where buyers and sellers come together to trade shares. There are many stock exchanges around the world, such as the New York Stock Exchange or the Bombay Stock Exchange. So, how does the share market work? Well, prices in the share market are driven by supply and demand. When more people want to buy a particular share, demand is high, and fewer people want to sell, supply is low, the price goes up. Conversely, when more people want to sell a share, supply is high, and fewer people want to buy, demand is low, the price goes down. You might also have heard the terms bull market and bear market. A bull market is characterized by rising prices and optimism. It's called a bull market because a bull charges forward with its horns, symbolizing upward movement. On the other hand, a bear market is marked by falling prices and pessimism. It's called a bear market because a bear swipes down with its paws, symbolizing downward movement. It's important to remember that the share market is not a gamble. It's a platform for informed decision-making, where you can earn profits if you understand the basics and keep yourself updated with the latest trends and news. The share market isn't a mystery. It's a puzzle waiting to be solved. Is investing risky? Yes. Can it be rewarding? Absolutely. But let's dive a bit deeper into that. The world of investing is a vast ocean of opportunities, but it's also filled with potential hazards. It's like a roller coaster ride with thrilling peaks and gut-wrenching drops. The risks are real and they can be intimidating. You might lose some or even all your money. The market can be unpredictable, influenced by myriad factors such as economic indicators, political events, natural disasters, and more. However, it's important to remember with greater risks often come greater rewards. When you invest, you're essentially putting your money to work. Your investments have the potential to grow exponentially, providing you with financial security and the possibility of an improved lifestyle. Over time, these returns can significantly outpace what you might earn from keeping your money in a savings account. But how can you navigate these risks and rewards? That's where risk management and diversification come into play. Risk management is about making informed decisions, understanding your tolerance for risk, and being prepared for different outcomes. It's about not putting all your eggs in one basket. Diversification, on the other hand, is about spreading your investments across different types of assets, sectors, and geographical locations. It's a strategy to mitigate risk by not being overly reliant on any one investment. If one sector of the market is hit, your other investments can help cushion the blow. The key is to strike a balance between risk and reward. It's about finding that sweet spot where you're comfortable with the level of risk and satisfied with the potential returns. Remember, investing is not a sprint, it's a marathon. It takes patience, resilience, and a well-thought-out strategy. So, is investing a gamble? It can be if you approach it recklessly. But with careful planning, sound decision-making, and a dash of courage, it can also be a rewarding journey. After all, every great venture involves some degree of risk. Risk is part of the journey, but so is the reward. Ready to dip your toes in the world of investing? It's easier than you might think. Let's break it down into 4 simple steps. First things first, you need to start saving. It's impossible to invest without money, right? So, before you dive into the sea of investing, make sure you have some savings set aside. This doesn't mean you need to save up thousands before you begin. Even a small amount can kickstart your journey. The key is consistency. Make a habit of setting aside a part of your income, no matter how small, every month. Next, do your research. You wouldn't buy a car without knowing its features or a smartphone without understanding its specifications, would you? The same applies to investing. Spend time understanding different types of investments, like shares, bonds, mutual funds, and so on. Learn about their risks, returns, and how they fit into your financial goals. There are plenty of resources available online. Use them to your advantage. The third step, choose the right investment. Now that you've done your homework, it's time to make a decision. But remember, there's no one-size-fits-all when it comes to investing. What works for one person might not work for another. Your choice should align with your financial goals, risk tolerance, and investment horizon. You might prefer a low-risk investment like a fixed deposit if you're risk-averse. Or you might go for high-risk, high-return options like shares if you're an aggressive investor. The choice is yours. Finally, monitor your investments. Investing isn't a set-and-forget game. It requires regular monitoring and adjustments based on market conditions and your financial goals. This doesn't mean you need to check your portfolio every day obsessively, but a periodic review, say every quarter or half year, can help you stay on track and make necessary adjustments. Starting to invest might be challenging, but remember, every expert was once a beginner. So take the plunge and start your investing journey today. After all, the best time to start was yesterday. The next best time is now. Investing is not a sprint, it's a marathon. We have journeyed together through the realm of investing, and the share market today. We peeled back the layers of what investing truly is and how the share market operates as a platform for growth. We talked about the balance of risks and rewards and how they play a crucial role in this journey. Remember, every risk carries the potential for reward, and every reward is earned through some degree of risk. We also walked through the initial steps needed to embark on your investment journey. There's a wealth of knowledge out there waiting to be tapped into. So, continue doing your research, keep learning, and start making informed decisions. Investing is a journey of patience, discipline, and continuous learning. It's about making your money work for you to create a secure future. Remember, the best investment you can make is in yourself. Start investing today.